First, on the macro level, I watched the ticker on Cypress Semiconductor, my old company, for 34 years every day. And one of the things I got to tell you, I actually wore my tie this morning, a tartan, is that tartans go out of style every 10 years, and then my wife and I like tartans, and then they come back, and it's a big deal every 10 years. So semiconductors go in and out of style. And that is the macro view. There's always a bunch of micro things that you can talk about. Are the Koreans attacking? Are the Japanese attacking? Is China going to start messing with the market? Trade wars, etc. But basically, if you go look at Semiconductor Composite Index, SOX, it always bottoms out in October, November. That's the week pre-Christmas. Everything's shipped for Christmas already. And it always peaks out around April, May. So number one, we are in the unfavored tartan phase, and we're about to come back to it because the overriding factor on semiconductors, which is way more important than the news of the day that all of which you just cited, is Moore's Law. And Moore's Law says that every year chips get 30% cheaper for the same function. And from my time in semiconductors, starting 1970, when I came to Silicon Valley to now, that Moore's Law compounded 30% cost reduction curve is a factor of 300. Okay, I want to bring it home. Let me apply that learning curve to cars. I did a little math this morning. If cars had followed the same learning curve since I got in semiconductors in 70, today you'd be able to buy a car for $100, and it would go around the world 25,000 miles on 1 gallon of gasoline. So it's amazing beyond belief, and that's still happening in the semiconductor world, and that will overwhelm any news of the day. It may go underwater for a while and come back. In this case, I don't think we have the worry that it's going to go down in October, as always, and stay down for a year, unless the economy crashes, because we've got some big things driving semiconductors. All your cell phones are going to become obsolete, and we're going to go to Gen 5. Point one, so we're gonna have a new wave of cell phones. The new frequencies are high, therefore they carry a lot of data, but unfortunately high frequency radio doesn't go very far, so you're gonna have to have a lot of stations to relay the signal.
No,
and the second thing, of
course, we talk about those long-term trends all the time. I think the question is whether or not the curve toward those trends has flattened somewhat, and hence investors willing to pay up a little bit less for growth in the near term. Is that fair or not? Okay,
so the question is normally I have this foolish view about stocks as you buy low and sell high. I didn't, truth in advertising, I still own a bunch of Cypress. It pays the dividend, and the 3% dividend is fine with me when the stock goes down, as long as I don't panic and dump at a capital loss. Right now the stock is, I'll give you Cypress just because I know the numbers, is trading at 1.7 times sales, which is like a 30+% discount to normal. I'm sure the SOX is the same way. Is it going to come back? My guess is it will come back by next April, May, the way it always does. And in the worst case, it might have a weak April, May, and cruise through the next year. But that's a heavy hit. That's a 2008, 1999, a 2001, 2008 kind of phenomenon. And unless we have that, these overwhelming economics I'm talking about, which, by the way, include not only cell phones, cars. Cars are going more electronic, way more electronic. And the two biggest things we own are going to have a wave of electronics, and that 30% per year Moore's Law rate will overwhelm what's in the market.